I'd like to start with you, Sal, on the notion of cryptocurrencies. If we talk about the status of what we're, kind of looking at these days, we know that the fund business has now gotten much more into the ability for investors to park their money in cryptocurrencies, but in ETF format. You run one specific product tied to a specific cryptocurrency, and that's XRP. Maybe take us through just what was the impetus behind launching an XRP-based ETF for a guy who's basically run commodity-related funds for years now.
Well, we naturally do derivatives-based products. And so we have commodities-based funds. And then when the derivatives came in, for crypto, we filed immediately for a Bitcoin fund. And for a variety of reasons, including some regulatory changes that happened, we filed under 33 Act, and 40 Act came in the midst of that filing. And 33 Act takes much longer. It takes 270 days versus 75 days. And that really, we missed because of that. We missed our opportunity to be first in a crypto derivative space. And so I'm familiar with XRP. I'm a fan of XRP. And that was natural for us. You still can't own XRP in an ETF, the coin itself, the token itself. But XRP derivatives came out. And slightly before they came out, we figured out a way to package them, put them into a double exposure ETF, which I think is what people wanted. You've got a lot of traders, a lot of very aggressive people that want to do that. And so we put it into XXRP, which is double exposure for XRP.
Okay, so what exactly are the maybe investors or traders, I guess, in this way? Because for traders, they're the ones often looking for some of these inverse or levered type products. When you target an audience for the ETF market like you have, what exactly do you see as the profile for the people who traffic more intensely in a double XRP ETF?
Well, it's interesting because as an ETF issuer, we don't actually see who buys our things directly. We have to design a product that we think there's demand for. And we very much suspected and knew, I will say, that there was demand for XRP and demand for tradable XRP product where people could get aggressive. And this is an aggressive product, obviously. It's levered. It's not designed to be bought and held at all. It's designed to be traded each day. And people love it. People love it. A lot of interest has been in it. It has very high trading volume, and good flows have come in the last 4 months.
All right, Eric, this is an interesting development here with regard to just how the ETF business has evolved, specifically in the last maybe 10 years, and even more so with ETFs that track cryptocurrencies. From an advocacy group standpoint, your firm is one of the ones who advocates on behalf of many fund managers out there, lobbies on their behalf. What exactly have you seen with regard to the adoption rate of crypto-related fund products compared to other seemingly hot trends that have kind of been capitalized on in the ETF industry over the last couple of decades?
Well, it's definitely growing very quickly. First, we got to keep it in mind that ETFs in general, not only crypto ETFs, record inflows. Already this year, $600 billion in net inflows into ETFs, which is the highest it's ever been. So we're approaching record levels. So when you take crypto ETFs as a portion of that, from our perspective, demand is really strong. Investors are interested. Firms like Sal's are innovating quickly. And we have a new regulatory environment here in Washington that is really encouraging this type of innovation.
Eric, if I could follow up on that, it's also a regime, if you will, these days, regulatory and fund management and otherwise, that seems to be warming more to the idea of having crypto-related ETF-type products. Just how much are perhaps asset managers, ETF fund managers, really on board with the idea of crypto, or is it just a situation where you kind of put the product out there because there's such latent demand for it? Is it because that these fund managers really do believe in the product, or do you think it tilts more to the idea that it's, give the people what they want, so to speak?
I think it's demand driven. Look, investment managers are there to serve the investors. And to the extent that investors are interested and curious in crypto products and other types of asset classes, there's going to be a response to meet that demand. A lot of our investment is still based upon fiduciaries and investment advisors. And I think that's really a personal conversation between individual investors and their advisors as to whether or not crypto is appropriate. But what we have seen is people are interested in crypto, and the industry has responded to that interest.
Sal, your product, you mentioned it is a levered product, so it seeks to gain 2 times the return of XRP on a daily basis, not necessarily for a prolonged period of time. We've told many stories, pitfall type stories about, some traders or investors who use these products thinking that they're double X over a 2-month, 3-month, year-to-date, 1-year type period, and then getting burned. If you look at the way that many of the allocators have been treating some of these cryptocurrency type funds, they have been treating them as allocation instruments because some people just want to, say, own a piece of it. It's different than the profile that you kind of attach your product to as well. How do you, differentiate, or how would you tell the audience about how to use funds like yours versus ones who are straight up tracking, say, the price overall of a particular cryptocurrency?
Sure. I think allocators and people who want a steady exposure in their portfolio to crypto should do an unlevered fund. They should buy a fund that just holds the token and goes up and down with the token very, very smoothly in terms of no leverage whatsoever, as little static as possible. There's always fees and expenses and some slippage and static around execution, but in all funds. But on a double levered fund, those leverages are reset daily. That it is really meant to be held for 1 day and 1 day only. People need to understand that. We tell them, it's written in the prospectus, you have to really beat the drum to let people know. If you just want exposure to a token, buy an unlevered fund. If you want to trade a token for price movement, then a levered fund could be an option for you. You have to really know what you're owning.
Anytime there are derivative instruments that underlie a particular ETF's products, you have to kind of treat them a little bit differently. As a person who's run, Sal, commodity-based ETFs and still does run commodity-based ETFs on agricultural products and things like that, just how different is running a crypto-related fund versus, say, a more traditional, I hate to use that term, but a traditional fund that tracks the movements of, say, an underlying product or futures product?
But in principle, they should be the same. In practice, because crypto's so new and the derivatives for crypto are so new, there's a lot more work involved on literally an hourly basis because you're finding liquidity, you're finding new players, you're testing the markets, you're testing the waters with these new derivative products that are out there. They're listed on exchange. They are well regulated. They're good products. That's why we use them. But the whole marketplace is getting used to it. So when you have a surprise success like the double XRP fund, XXRP, that causes you to scramble a lot more, finding trading partners, finding that liquidity, which we do. But it's a lot easier on established market like grains. Our corn fund, the futures have been around for 100 and something years on grains. It's a lot easier than a crypto future that's been around for weeks or months or maybe a year or two.